Happy Friday, everyone, and welcome back to Your Finance TV. As we do every Friday, we have Jay Pulaski here to talk about his musings from the week. How's it going, Jay?
Great, Scott. How about you, buddy?
Fantastic. And I love having you back here, especially after your trip last weekend. But I'm looking at your musings. Now, your signal this week is turn signals. Now, me being a foreigner in the US, I really do think that the US has some issues with turn signals because everywhere I drive around, no one seems to use them. Hopefully, you're getting some good turn signals out of this, which you can show and talk to the viewers today.
Yeah, that's a good one, Scott. I have to agree. I'm from Massachusetts, and Massachusetts drivers have a particularly bad reputation for their driving skill. But here, it just kind of struck me that we're in obviously a tricky situation. There's lots of different points of view. I mean, for the most part, people have been bearish. We've been talking about the curtain of FUD, right? Fear, uncertainty, and doubt. We've also talked about kind of our middle path, right? So that's really been the view that we've had for roughly a year now, this middle path between high inflation and deep recession. That's how we've been driving down the investment road. And more recently, as I just touched on, we talked about pulling back the curtain of FUD, right? Talking about SVB and how this created more uncertainty and worries about systemic bank risk and credit crunch. And we think that curtain of FUD is obscuring significant positive global policy changes, whether it be central banks deciding to accept a slightly higher rate of inflation, as we think the Fed and ECB and others are going to do, or whether it's the return of industrial policy to the US in the first time in 70 years, or it's Japan's move off of yield curve control. So huge policy changes rolling out throughout our tripolar world, and yet the curtain of FUD has obscured that from most investors' attention. And then most recently, we wrote about crunch time, is the title of our most recent musings. And there we basically painted a picture of a number of issues, policy-wise, Fed approaching the end of its rate tightening cycle, Bank of Japan approaching the end of yield curve control, as well as market-wise, right, with the S&P having had a very long trading range. We're right about at the point where trading ranges tend to end. And guess what? The typical catalyst tends to be the Fed. And oh, by the way, we have a Fed meeting coming up in a couple of weeks where they're probably going to pause, which will be a major change. And then finally, the debate or the battle between sell-side equity analysts who are forecasting earnings acceleration as we go through the year versus fixed income investors who are clearly looking for recession and expecting significant rate cuts by the end of the year. Those two are, not compatible, right? And so we fall down, as we talked about with crunch time, we're in the camp of the equity analysts. So when we put all that together, and then we hear or read about Stan Druckenmiller, the great investment guru, saying that this environment's the most uncertain he has seen in his 45-year career. That was a quote from the FT article where he was featured. And that suggests to us that, let's put some of these turn signals down that we're seeing across all the reading and different research that we employ here at TPW Advisory. And so that's really what we've done. We simply have pulled from different things that we've seen over the past week. Literally, all of this comes from the last week. 20, not just 5, not 10, not 15, but 20 turn signals that we think are valid for investors to consider. And they range from market-focused stuff like earnings or bear market history, et cetera, to company activity, to kind of, what's happening in shipping and freight and transportation, all kind of leading indicators, right? Because we're in the early cycle camp. We believe we are in the early cycle of a global economic acceleration. Most of the market is arguing that we're in late cycle and we're about to go into recession, big earnings drop, et cetera, et cetera. So it's time for turn signals, time to use the turn signals, to your point that folks in America don't use them. TPW Advisory not only uses them, but we provide them for you.
Well, actually, you do. In your musings this week, you've got 20 different turn signals. And I think some people in my town have never used them once. But let's break down some of these US turn signals that you're looking at. It is actually a great read. The viewers really should be looking into this musings, also your other musings. But this was great. I really like this week.
Yeah, thank you. And it was, it just struck us that there's, we want to have a wide funnel, basically, right? When things are uncertain, you want to kind of have a wide range of things to input to kind of help you decide. You don't want to be focused on one narrow indicator or one, model that you've always looked to. You want to be a little bit more open-minded. So this is our effort at being open-minded. And we start with the S&P Global PMIs for April, which just came out over the last week or so. And it showed that US and European business activity are at their highest levels in a year. Highest levels in a year for business activity in both the US and Europe. That's certainly not recessionary talk. And I would note, because there's a lot of concern about manufacturing, that the manufacturing PMI for the US came in over 50, which signals expansion. The estimate was 49. Now, some people say that they much prefer the ISM PMIs, right, because there's a longer history. But when you look at the two together, you realize that they tend to go in the same direction. So if the S&P Global Manufacturing PMI for the US is pointing to expansion, and the ISM is still below 50, it's likely that the ISM will pick up and support that S&P Global early read. The other thing I would just note in terms of, are we early cycle into recovery or are we about to head into recession, is that the composite, so manufacturing plus services, bottomed in the US at 45. April's number was 53. So that's that's pretty compelling to us in terms of thinking about where we are in the cycle. And then we looked at demand coming from the shipping industry. And we remember all during COVID, how many ships were lined up outside the port of Los Angeles. Today, the good news is that there are about 12% more ships lined up outside of LA or due into LA than there were a year ago. So in other words, the shipping cycle is starting to pick up. Here's another little data point we gathered, that the average cost to ship a container from Shanghai to Los Angeles, roughly $1,900, was up 11% year over year in the past week, the first week over week increase in 3 months. So again, these are little harbingers, like little things to pay attention to that give you a higher sense of confidence about where things are going. Here's a couple more. A lot of talk about leading economic indicators continuing to point down. And yet we saw some interesting work from Oxford Economics suggesting that there's a near-term recovery about to unfold in manufacturing in the US as well as globally. And then there's huge amounts of talk about liquidity, right, and M2 and how M2 has declined. But Ned Davis, which is a very well-respected research shop, they have a real monetary, fiscal, and exchange rate policy index that shows policy easing, not tightening, easing, after spending most of 2022 in a tightening mode. And then here's one that really struck me. The average length of bear markets, right? So this is from Stratagas, and we highlighted every source at the end of each one of the turn signals. So Stratagas, again, very well-respected research shop, highlighted some work they'd done over bear markets. and pointed out that it's super rare, and that's their term, to go longer than 300 days in an SPX decline. You have to talk about some of the worst all-time sell-offs. And if October was not the low, and in our view it was, but if you're a guy who say, no, we're going to go down to new lows, you have to understand and appreciate that that would make us be in the sixth longest bear market in the last 70 years. And you just have to wonder, are things really that bad? And we would argue no. And one of the things that makes us argue no is home builders, right? And we've talked about home builders. You know that we put a position in XHB into our global multi-asset model now 5 months ago, maybe, give or take. And home builders are now hitting all-time highs. Pulte, which just reported, just hit an all-time high. So it's really worth paying attention to, because home builders tends to be where, when Fed jacks up rates, home building, crashes, and that's the thing that is a typical recession signal. In fact, we have not gone into a recession when housing is providing growth to the economy at any point other than 2001, which we know was a shock from the tech and 9/11. So here too, now we're not yet at the point where residential investment is a positive for GDP, but the rate it's contracting from GDP has shrunk dramatically over the last several quarters, including in Q1. And then I'll finish up here kind of on the U.S. segment by noting that the Chicago Fed in their National Activity Index is suggesting inflation risk remains low. The 3-month moving average is far above the mark that signals recession. So, there's a lot that we see in kind of turn signals that suggest we're turning away from the risk of recession, not turning towards it, at least in the United States and for sure in Europe and in Asia.
Okay, so that's a lot to take in the US, but you are a tripolar world. So let's discuss Europe and Asia.
Yeah, Europe's a great one. I mean, we highlight here how Germany, the German government just raised its 2023 GDP forecast for the second time in the last several months, continuing to suggest that the German economy, and Germany is the biggest economy in Europe, and Europe more broadly is going to continue to expand and grow. And Europe's Q1 GDP number just came out this morning. It's not super strong, but it's in a positive camp. And keep in mind that a few months ago, virtually everyone had penciled in recession into Europe for 2023. Remember the fears about winter and gas shortages and all that type of thing. But here's even the more important point for investors, Scott. The European stock market is up 33% over the last 6 months in dollar terms, okay? Look at FEZ. That's what I take that number from. 33% in the last 6 months. You know what the S&P is up over the last 6 months? 6%. So my point is, not only is Europe outperforming the US, and we've been overweight Europe for all of that and more. We've captured all of that outperformance. But the more important point is that stocks in Europe started to go up 6 months ago, when everyone was super bearish and worried about a recession in the winter because of sky-high energy prices, right? Yeah. Stocks see through that. Stocks are forward-looking discounting mechanisms. And so European stocks, 33% up over the last 6 months, while the governments and others are just starting to pencil in recovery now. Stocks are way ahead of it. And so I think that's important to think about in terms of, the U.S. and what the U.S. stock market, up 7% in Q4, up 7% in Q1. What is that telling us, okay? So then we move on to China, which is another important part of the world. We think it's accelerating its growth. Stocks have been disappointing, right? We're overweight Chinese equity. and it hasn't really worked this year. It was great at the end of last year. So we had that big move up when zero COVID was dropped. And then we've really kind of given much of that back. And here's a quote from Goldman Sachs. Chinese companies who have reported first quarter earnings, 90% have given positive profit guidance, up from the historical average of 60%. Goldman Sachs forecasts 20% earnings growth from Chinese equity for 2023. So that's a real, that's a really big number when you look at the rest of the world, where earnings expectations in terms of percentage of profit growth is quite low. And so let's talk about that because we do have data here this is from JP Morgan. So that last quote, Goldman Sachs. Here we talk from JP Morgan. 81% of US companies reported to date, this is through yesterday, 81% beat estimates. And of course, we all know the game. Analysts lower the estimates before the quarter, the companies beat, etc. But it's important to note that top line growth coming in at 5%, significant surprise, 5% above expectations year over year, significant surprise. In Europe, 74% of companies have beat. There too, revenue growth is 7% year over year. This is part of the high nominal growth world that we've been talking about. When you're growing nominally at 6 to 8%, as we are in the US and in Europe, and granted, a big chunk of that's inflation. But let's remember, earnings and sales are reported in nominal dollars. So when you have high nominal growth, you're going to have good sales growth, and then there's room for companies to continue to work on the margin and generate earnings growth. In Japan, year over year earnings growth. Japan's a market we like a lot. EWJ just broke out to a new 52-week high. Earnings growth in Japan growing 18% year over year. 18% earnings growth in Japan. Okay, you would never think about that when you listen to people talk about Japan. So last point on the earnings, that Ned Davis talking about how non-US earnings are in cyclical recovery, and that typically investors need to remember that typically equities bottom first before earnings and before the economy. And certainly, and this is from Fidelity, before most investors get back to a fully invested position. And that's really the key point. So earnings look good. Lots going on to suggest economic activity looks good. And those are a bunch of the turning points. And then we have some more we could probably talk about as well.
Well, as you said, like earnings has been a big thing, right? Like I think it was 35% of the S&P reported this week.
Yeah, that the data we just talked about there with US, Europe, and Japan, that's from JP Morgan. They do a really pretty good job of doing that, and they update it. But my point is that you have high top line growth, right, in the US and Europe, and that's what people have continued to miss. I mean, we've been talking about it for a year, if not longer, about high nominal growth, and people still seem to struggle with understanding it. I think it's in part because the 2010 through 2020 period was low growth, low inflation, low nominal growth, right? Nominal growth in the US in 2010 to 2020 averaged, like, I believe, 3.5%. And we're in 6 to 8%. Last year was 8 to 12% nominal growth. Again, lots because of inflation, but earnings and sales are in nominal currency. So that's something that people continue to miss.
The Q1 GDP was out this week as well, Jay. What did you think on that?
That's actually perfect. That's where we ended up with our turn signals, and we highlighted that while Q1, the flat number of 1.1% was kind of below where people were expecting. But a large part of that, you really, again, perfect example of needing to dig into the details and look for the turn signals, not just take the top number and say, oh, 1% growth, that's lousy, I don't like it, I'm out, type of thing. The points we would pick up is that real disposable income was up 8% in the quarter, the best gain in a decade outside of the COVID, stimulus period. When you have real disposable, so that's after inflation, disposable income of 8%, the best in a decade, that's not recessionary, right? We're in an economy in the US at 70% consumption. If you have real disposable income growth going almost double digits, it's very hard to see recession. And so that drove up consumer spending, which was up almost 4%, the best since 2021. And so then you ask, well, why was the total GDP only 1%? A big part of that was inventories, right? Inventories were drawn down dramatically. And so you have inventory taking away a couple of percent. And as I mentioned earlier, with home building, residential investment is still acting as a drag on the economy, though that drag has continued to decline, and we expect it to become a positive as we go through the rest of the year. The other thing to mention is inflation, right? And the concern about inflation. And here we picked up a signal on rent, because rent, as we know, shelter is 40% of the overall CPI. And the point here is that rent is finally coming down, right? So the month over month pace of rent growth in the US was 0.5% in March versus an average of 0.8 in the second half of 2022. The rollover in rents is finally here. That's a quote from Pantheon Economics. And so we expect to see continued declines of inflation. That's the turn signal to suggest to the Fed, hey, we can go on hold here. Whether they raise 25 or not, I don't think is at all relevant, right? The key is what they do after that. And we expect a pause to allow the Fed to kind of assess where things are. And we think that's going to kick off a real opportunity set, because our very simple-handed kind of nature or mantra rather on this is Fed on hold equals a weak dollar equals rest of the world outperformance. And so that's really our view. We think the earnings are going to be fine. We highlight that earnings expectations are picking up, not going down. We think the bears are running out of time. And as we touched on at the beginning, we expect the Fed meeting to catalyze a move up and out of the long trading range that the S&P has been in, now approaching 250 days, tends to end around 255. So I don't want to say exactly in the week, but we're at the end, what would typically be the end of a long trading range. And we have the Fed meeting, which typically Fed is a catalyst. And so that's how we're kind of looking for things. And I would just note, just take a look before we got on, the S&P is now, as of whatever, 12 o'clock today, less than 0.5% away from its year-to-date high. It's roughly 3.5% away from its 52-week high. And it's roughly just a little bit more than that, 3 to 4% away from what would constitute a new bull market. If you take the October low to roughly 4,300 and change, you're at 20% move, which would kick off a new bull market. And that's what we expect to see happen, that kind of activity, which will pull in a lot of the negative, underweight, heavily cashed up investment community once we break through 4,200 and onto 4,300, and the papers start getting filled with, new bull market. That's going to be a real shift for people.
Yeah, you got 20 turn signals in there in these musings, Jay. Hopefully they're all pointing towards good news going ahead.
Well, they are. Yeah, they are selected by us, curated by us, and they are pointing in the direction that supports our point of view, which is constructive. But, we also just note that we had a really fun time doing a bull-bear debate with a good buddy of ours, Chase Taylor at Pinecone Macro. We attached a link of that in our musings, so folks can go to Pulaski.com and sign up for the musings and check out that bull bear debate. It was a fun time.
Sounds great. Well, Jay, listen, thank you so much for that. And I hope everyone's definitely signing up at Pulaski.com to go see these musings. It's fantastic. But you have a great weekend, okay?
Well, you as well, Scott.
And for everyone else out there, good luck investing.